Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Vanke Co. Limited annual report. China Vanke Co. Limited is a leading property developer that offers a wide range of services and businesses. At its core, the company engages in the development and sale of properties across mainland China, Hong Kong, and internationally. This includes residential properties, construction contracts, commercial property operation, asset management, and related services. In addition to property development, China Vanke also provides various other services such as community residential and consumption services, enterprise and city space services, and artificial intelligence Internet of Things and business process as a service solution. The company has diversified its portfolio by investing in shopping centers, logistics and warehousing services, supply chain solutions platforms, and hotel and resort businesses. Furthermore, China Vanke offers residential solutions for urban residents, providing them with housing rental options. The company also operates in the food, tourism, cultivation, and housing rental sectors. With a presence in multiple industries, China Vanke has established itself as a major player in the Chinese real estate market. China Vanke Co. Limited maintains a market capitalization of $48 billion, broadly in line with the industry peer group. China Vanke Co. Limited trades at a lower price-to-book ratio of 0.18 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 74% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. On one hand, revenue growth is primarily driven by sales of properties, rental income from investment properties, and changes in use of properties. These factors contribute positively to a company's top-line growth. On the other hand, revenue decline is often attributed to decreases in contract liabilities, increase in write-downs of inventories, decrease in contract costs recognized in profit or loss, and losses from operations. Market and economic factors such as insufficient effective demand, market differentiation, industry downturn, and decreased sales revenue also play a significant role in driving revenue decline. Company-specific factors, including connected transactions and share repurchase, can also impact revenue growth or decline. Additionally, other factors such as property market conditions, land appreciation tax, and withholding tax may influence revenue performance. Understanding these drivers is crucial for businesses to make informed decisions and navigate the complexities of their industry. The net income of the company experienced a significant decline, decreasing by 79% year-on-year to a loss of RMB 88.56 billion. This substantial drop was attributed to the industry downturn and rigid costs. The profit margins also suffered, with the gross profit margin for real estate development and related asset operation business plummeting by 9.5 percentage points to -2.3%. Similarly, the operating profit margin decreased by 8.3 percentage points to -7.1%. The decline in net income and profit margins can be attributed to various factors. The industry downturn had a significant impact on the company's performance, leading to a substantial decrease in revenue. Additionally, rigid costs further exacerbated the situation, making it challenging for the company to maintain profitability. As a result, the company experienced a significant loss, highlighting the need for cost-cutting measures and strategic adjustments to navigate the current market conditions. The decline in profit margins was also evident across various segments of the business. For instance, the gross profit margin decreased from 9.3% in 2024 to 0.2% in 2025, while the net income margin dropped from -14.1% in 2024 to -16.6% in 2025. These figures indicate a significant deterioration in the company's financial performance, underscoring the need for immediate attention and corrective measures. In conclusion, the decline in net income and profit margins was a result of the industry downturn and rigid costs. The company must take proactive steps to address these challenges and implement cost-cutting measures to restore profitability. The company's operating cash flow is a mixed bag. While there are instances where it generates positive operating cash flow, such as in the second and fourth quarters of the year, with inflows of RMB 5,632,885 and RMB 1,019,014 respectively, there are also periods where it experiences negative operating cash flow. In fact, in some quarters, the company's net cash generated from operating activities is actually a significant outflow, as seen on page 10, where it reports a net cash outflow of 988,124 RMB 0 in 2025. This inconsistency suggests that while the company has moments of positive cash flow, its overall performance is not consistently strong. The company's debt level has undergone significant fluctuations over the years. Initially, there was an increase in total debt from RMB 123 million to RMB 142 million between 2023 and 2024. However, this trend reversed in 2025, with a decrease in debt level from RMB 137 million to RMB 93 million. The following year saw another decline of RMB 2.79 billion, bringing the total debt down to RMB 358 million. Notably, there was a significant increase in debt from RMB 0 in 2024 to RMB 30.8 billion in 2025. In terms of interest expenses, the company experienced a decrease of 85 basis points between 2023 and 2024, resulting in a consolidated cost of 3.02%. However, this trend was short-lived as interest expenses increased by RMB 131 million in 2025 due to various factors such as exchange rate fluctuations. The total interest expenses also saw an increase of RMB 6.66 million during the same period. The performance of various segments and regions within the company has been mixed. On a positive note, the development business saw significant growth, with cumulative contracted sales reaching RMB 134.06 billion and an investment fulfillment rate of 84% for new projects. The property services segment also performed well, with over 300 Wonwo towns improved and transformed, and 52 external energy management service contracts secured. The commercial projects segment was another success story, with the Shanghai Kaianwen In-City Mega opening successfully and setting city-level benchmarks. Additionally, the long-term rental apartments business and high-standard and cold chain warehouses business maintained industry leadership. However, not all segments fared as well, with the logistics and warehousing business and commercial business performing poorly. The property development segment saw a decline in revenue and profit, with a significant decrease from RMB 195 million to RMB 183 million, and a loss of RMB 19.5 million respectively. The overall company performance also suffered, with a 33% decrease in revenue and a 204% increase in losses. On the other hand, the property management segment saw relatively stable revenue, but a slight decline in profit. Management is expressing concern about the company's outlook due to several factors, including decreased settlement profit, increased business risk exposure, and losses incurred by operating businesses. However, they are prioritizing revitalization of existing resources and targeted investments to improve efficiency and tackle challenging projects. To achieve this, management is focusing on optimizing project execution, emphasizing government-enterprise collaboration for revitalizing stock, and optimizing asset structure. They are also deepening and iterating the good housing system to lead high-quality living experiences and actively responding to policy guidance. In addition, the company has a going concern issue, but management believes it will be able to continue as a going concern for at least 12 months by expediting sales of property, reactivating existing assets, optimizing business operations, and conserving capital expenditures. The company is also adjusting its organizational structure with two reportable segments: property development and operation, and property management. Overall, management strategy involves revitalizing existing resources, improving efficiency, and adapting to industry changes while prioritizing high-quality development and government enterprise collaboration. The company has made significant acquisitions to expand its business and operations. One notable acquisition is China Vanke Property Development Co., Limited, which was acquired as per the information on page 275 of the extracted summaries. Additionally, the company has also acquired an equity interest in entities through cooperation agreements, although the exact percentage of ownership is not specified. This indicates a strategic move to diversify and strengthen its portfolio through partnerships and investments. The company has a history of paying dividends to its shareholders. According to the extracted summaries, dividend payments were mentioned on multiple pages, indicating a consistent practice of distributing profits to investors. However, there appears to be some confusion regarding the payment of dividends for 2025, with one statement suggesting no dividend was paid and another stating that dividends were declared to non-controlling interests. Despite this discrepancy, it is clear that the company has made dividend payments in previous years. On the other hand, there is no evidence to suggest that the company has engaged in share buyback activities. The summaries do not mention any repurchase of shares by the company, indicating that its capital management strategy may focus on distributing profits through dividends rather than buying back shares. Concerns about inventory buildup and supply chain disruption have been raised in several instances within the company's operations. On page 5, it is noted that there is an inventory buildup with no immediate supply chain disruption. However, by page 13, this concern has escalated to include a goal of reducing inventory levels. The situation takes a more serious turn on page 37, where it is reported that inventory has decreased by 28% from the previous year. Furthermore, the company has recognized an additional provision for inventory impairment of RMB 20.83 billion during the reporting period. This suggests that the company is taking steps to address its inventory buildup issue. In addition to inventory concerns, there are also indications of supply chain disruptions on page 111. The report highlights significant volatility in raw material prices, contractor defaulting, labor disputes, safety incidents affecting project development and operations, and challenges facing the construction industry, with declining economies of scale and corporate insolvencies intensifying further. The pledge guarantee provided by Dongyuan Wanwei Supply Chain Co., Limited, on page 144 also raises concerns about supply chain stability. The actual amount pledged is significantly lower than the guaranteed amount, which may indicate potential issues in the company's supply chain management. Overall, these instances suggest that there are legitimate concerns about inventory buildup and supply chain disruption within the company. That concludes the financial summary for China Vanke Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.